Welcome back to our channel. In today's video, we're diving deep into the world of investments and exploring how you can strategically grow your money in the face of today's inflation. As you may know, inflation is on the rise, currently at 3.67% in the US, and this trend can erode the purchasing power of your money. So, how can you not just preserve but grow your wealth during these times? We've got 8 strategic assets to consider. So, without further ado, let's dive into it. Asset 8: Gold, silver, and precious metals. Our first strategic asset is the time-tested choice of gold, silver, and other precious metals. These have been treasured for centuries, and their appeal shines brightest during inflation. When the value of traditional currencies like the dollar diminishes, precious metals tend to maintain their value. Historically, gold has outperformed silver during inflation, but it comes with a higher price tag. You can either buy the physical metal or invest in exchange-traded funds, ETFs, that track their value. Diversifying into both can optimize returns while minimizing risks. Asset 7: Various commodities. When inflation rears its head, commodity prices often experience a substantial upswing, presenting an enticing investment opportunity. However, investing in commodities comes with its own set of considerations. Their prices are highly influenced by supply and demand dynamics, meaning you can either make gains or losses based on market fluctuations. A classic example of this occurred in 2020 when the global oil prices surged following the Russian invasion. Those who invested in oil just before this geopolitical event enjoyed substantial profits. Similarly, supply chain disruptions caused by the pandemic led to a surge in lumber prices. Those who had invested in lumber during this time enjoyed significant gains. It's important to note that most commodities have a shelf life. So, while it makes sense to invest in oil, it might not be wise to stock up on perishable goods like avocados, hoping to sell them for a profit later. For a more practical and less risky approach, consider investing in exchange-traded funds, ETFs, that track specific commodity indexes. This way, you can potentially benefit from price increases without the concern of the commodities expiring. Asset 6: Cryptocurrency. While it may not be the most common choice among the wealthy, it has garnered increasing attention in recent years. Cryptocurrency is essentially digital money that relies on blockchain technology to track transactions. It's a relatively new and more complex investment compared to traditional options, but it offers a unique set of potential advantages. One key factor that makes cryptocurrency intriguing during inflation is its limited supply. Mining or creating new cryptocurrency units is resource-intensive and doesn't guarantee immediate benefits. This limited supply means that the market doesn't get flooded with excessive new cryptocurrencies, which helps maintain the value of existing ones. Another crucial feature is that no government or financial institution oversees or controls cryptocurrency. Unlike traditional money, this independence makes it free from traditional market influences. However, it also introduces both higher risks and potentially higher rewards. While diversifying into well-established investment options is advisable, allocating a portion of your portfolio to cryptocurrency could provide significant returns if you're willing to accept the risks involved. Asset 5: Treasury inflation-protected securities, TIPS. These government bonds offer a unique way to safeguard your money against the erosive effects of inflation. Here's how they work. When you buy a TIPS bond, the principal value adjusts with inflation, ensuring that your investment keeps pace with the rising cost of living. But that's not all. The interest payments also change in response to inflation. If inflation surges, the total growth of your TIPS investment becomes significantly higher compared to traditional bonds. The beauty of TIPS is their ability to shield your principal amount from the negative impacts of inflation. It's an excellent choice for retirees looking to maintain their savings' real value over time. The best time to invest in TIPS is before inflation takes off. By doing so, you can fully benefit from the increasing bond value and the rising interest payments as inflation climbs. If you wait too long and buy them after inflation has already set in, you might find your investments have already declined in purchasing power. So, TIPS are worth considering if you're looking for a low-risk way to diversify your investments. Asset 4: Savings bonds. These bonds offer a unique combination of fixed and inflation-adjusted interest rates. The inflation-adjusted rate is reviewed and adjusted every 6 months based on the latest inflation data. For example, as of now, the composite rate for I-bonds issued in May 2023 is 4.30%, and this rate remains locked until October 2023. I-bonds present both short-term and long-term investment opportunities. While an I-bond can continue to earn interest for up to 30 years, you're not locked into it for that long. You can cash out the bond after just 1 year, but be cautious, as cashing out before the 5-year mark results in losing the last 3 months' worth of interest as a penalty. After holding the bond for 5 years, you can cash out without any penalties. I-bonds provide an intriguing option for investors seeking a mix of safety and growth. They offer protection against inflation and can be a valuable addition to your investment portfolio. The flexibility they offer makes them a practical choice for both short-term and long-term financial goals. Asset 3. Stocks. While investing in stocks can offer substantial returns, it also comes with a fair share of risk, particularly during inflationary times. To navigate this landscape, many individuals, especially the wealthy, seek ways to safeguard their wealth. One favored option is utility stocks, which come from companies that provide essential services like electricity and gas. These stocks are appealing because these companies often share a portion of their profits with investors in the form of dividends. What makes these utility companies particularly attractive during inflation is their ability to adjust their prices when costs rise, ensuring that they remain profitable even in changing economic conditions. Another option that provides both diversification and lowers risk during inflation is stock index funds. You can find these as mutual funds or exchange-traded funds, ETFs. These funds represent a collection of companies, such as those in the S&P 500. By investing in these funds, you're essentially putting your money in multiple companies at once, which can lower your risk exposure, especially during inflation. Asset 2. Debt. While it may seem counterintuitive, certain types of debt can protect your money during inflation. One example is leveraged loans. These loans can adjust their interest rates to match rising prices. When inflation happens, the interest rates on these loans increase, providing investors with an opportunity to earn higher returns. This is particularly attractive to those who are looking for ways to keep their investments ahead of the inflation curve. Another option that's favored by the wealthy includes investments in mortgage-backed securities and collateralized debt obligations. These are essentially financial products that bundle many different loans together. Instead of directly owning individual loans, investors put their money into these structured products. However, it's important to note that investing in mortgage-backed securities, collateralized debt obligations, or leveraged loans can be complex and carry certain risks. Additionally, they often require a substantial amount of capital to get started. For regular investors who are seeking a more straightforward approach, consider mutual funds or ETFs that specialize in these income-generating products. They provide exposure to these assets without the need for significant capital and are managed by financial professionals who navigate the complexities on your behalf. Asset 1. Real estate. Real estate investment, such as owning houses or apartments, is a popular choice, especially among the wealthy. These properties often appreciate in value when overall prices in the economy rise. The rationale behind this is quite simple. Everyone needs a place to live, and this consistent demand ensures that real estate typically appreciates over time. There are various ways to invest in real estate. One option is to own rental properties, where you earn money from tenants paying rent. However, this also involves the day-to-day management of properties, which may not be everyone's cup of tea. For those who prefer a more hands-off approach, real estate investment trusts, REITs, are an excellent alternative. REITs are companies that own income-generating properties, ranging from shopping malls to apartment complexes. By purchasing shares in these companies, you can reap the benefits of real estate without the associated management responsibilities. Navigating the financial landscape during inflation can be challenging, but with strategic asset allocation, you can not only protect your wealth, but also grow it. Each of these 8 assets has its advantages and risks, so it's crucial to carefully assess your financial goals and risk tolerance before making investment decisions. If you found this video helpful, Don't forget to like and subscribe for more valuable financial insight. Thank you for joining us today, and we'll see you in the next video.